Okay, thanks everybody for being here. So this is joint work with Christine Palour from UC Berkeley and Marius Soikan, who is also in Calgary. So I'm a finance professor, so I might have a slightly different perspective than some others. And we want to look at fragmentation on decentralized exchanges. So what's kind of puzzling is that a lot of assets on Uniswap v3 are trading both in a high fee and in a low fee pool. And initially when Uniswap v3 was launched, the idea was that trading would converge into one pool, and that was the pool that would best suit the traders. And so it's not totally obvious why we have trading in both pools. And furthermore, the question is, does fragmentation of liquidity, is this bad or is this okay for traders? So we build a little game theory model where we have liquidity providers that earn fees and face adverse selection costs, and they also have gas costs. And these gas costs, as it turns out, are crucial to get this segmentation. So what we find is that the small liquidity providers, like I would be, with small amounts of money, they go to the high fee pool and they earn a high fee on few trades, but those trades are usually large. And they save gas costs because they don't need to rebalance that often. Versus the large liquidity providers go to the low fee pool and they have a fixed gas cost that's not very relevant for them, so they don't care whether they rebalance or not. And they earn a low fee per trade, but they earn a lot of, they have a lot of small trades where they earn fees. So what our model can say is that this fragmentation is ultimately good for trading. So it attracts more liquidity overall and increases gains from trade. So this is better than if you would just have one pool. So let me show you some stylized facts that we have from a large sample of Uniswap v3 interactions. So the high fee pools are larger, but they have lower trading volume. The high fee pools have the smaller LPs that provide liquidity in those pools, but they have very large trade sizes. And the high fee pools have longer liquidity cycles. So people there don't rebalance their liquidity that often. And on the low fee pool, liquidity rebalancing is much quicker and faster. So we build a little game theory model that I will not present here, but you can look it up in the paper. So we have liquidity providers, the different endowments, there's rich and poor ones. They pay gas costs whenever they readjust, and those LPs optimally choose the pool in which they want to provide liquidity. We have then liquidity traders who trade for some random reasons because they just want to buy a new car or something else, or they need the money. And then we have arbitrageurs who trade on news arrival. So the arbitrageurs understand that the price, the fundamental price of the token has changed, and they trade on this information. And this is why they also create adverse selection costs for the liquidity providers. So the arbitrageurs and the liquidity traders both optimally also choose which pool they trade in when they are active on the market. So as usual, the LPs find it optimal to be in that market, so they balance the fee revenue with adverse selection cost to optimally decide how much liquidity they want to provide and if they want to provide liquidity at all. So what we do get in our model is that there is some equilibria, and you can see on the top graph here where there's only one pool, and that happens when there's a lot of news about the token and when the pool fee for the low fee pool is very low, so that's the white area. So if there's a lot of new information that is to be learned about the token when the fundamental value changes very often, then we have only one pool. And in the shaded area, we do see that when there's not so much news and the fee of the low fee pool is not so much lower than the high fee pool, then we see that we have fragmentation in markets. So the lower picture shows you the distribution of liquidity providers. So what we do see is that at the very left, there's a lot of small liquidity providers that do not provide liquidity because their endowment in the token is too small. It's not worthwhile for them to pay the gas cost. They stay out of the market. Then there's this middle chunk of liquidity providers, the smaller ones that go into the high fee pool, and then there is the very large liquidity providers, the hedge funds of the world, they go into the low fee pool. So all these borders, when does one segment end and when does the other segment start, is of course endogenously determined and optimal based on the decision of the liquidity providers, based on gas fees and other considerations in the model. So one thing we can, by building this model, one thing we can do is we can really say something to, is this fragmentation good or bad? And so we find that if we look at gains from trade, that fragmentation is very beneficial. So overall, we have higher gains of trade from fragmentation compared to what we would have in a single pool. So this is decreasing in the gas cost. Obviously, if the gas costs become very high, more liquidity providers drop out of the market, and so this wedge, all the gains from trade go down, but it's also the wedge between low fee two pools versus one pool decreases. So we do an empirical analysis too. We look at 270 pools and 242 assets, 24 million transactions on Uniswap v3. And what we do find is that all these stylized facts that I showed you before in this picture are confirmed if we use a fully fledged econometric analysis with control variables and weekly fixed effects and pool fixed effects and all the econometric shebang that you want to have. So all these stylized facts are confirmed. We do have some additional theoretical prediction on gas prices. So we do see that our model predicts then when the gas prices go up, that the market share of the low fee pool decreases and that the average liquidity deposit in both pools increase. And we do find that also confirmed in the data, which assures us that our model makes some kind of economic sense. The final thing we can say is that the liquidity yield, which is kind of fee revenue over TVL, is higher in the low fee pool than in the high fee pool. So as you can see my gray hair, I don't have any Twitter account up there, but I do have an email up there, and I created a QR code for the paper. So if you have any thoughts or want to talk more about this, I would be very happy to engage with you. Thank you.
Fantastic presentation, Professor Lehar. Is it Lehar? All right, perfect. Any questions there from the audience?
Do you see any parallels in this with the TradFi?
Do you see any parallels with this in TradFi?
In TradFi, we don't have a lot of parallels like this. So there's some studies that look at stocks that are listed in the home market and on the New York Stock Exchange when some companies do dual listings. And we see that then all the trading volume usually converges to one market. So this kind of liquidity fragmentation is not that common in TradFi. Yeah, we can think of gas fees as commissions, probably. That would be certainly one way to look at it, yeah.
Finally. Finally, I just have a question to ask there. Are there instances where the large whales or the institutions, when they're deploying liquidity, are they actually also losing out? They're making losses essentially?
Yeah, I think that is a very interesting question. What is the return of liquidity provision? And I've read a few papers on this, and in my personal humble opinion, I think there's still a lot of research that needs to be done on this. It's not totally easy for two reasons. First of all, I think these measures like lever or something that people have proposed that measure adverse selection costs are not really very good, because one way to think about this, to really better understand, is we need to distinguish between these liquidity traders and arbitrageurs that we have looked at, and I don't see that being done. And second, I think you want to have some kind of risk-adjusted return to say whether do they make good returns. It's a question of what is the risk. And the risk is a very non-trivial question. I think not a lot of people have looked at the risk of liquidity provision, and what kind of risk-adjusted discount rate we should charge is not that obvious, I think.
Lovely, thank you very much for that. And another round of applause, and then we're going to go into a quick panel discussion talking about DeFi 2.0.